As inflation has come down, the stock market has rallied. Most recently, the CPI, or Consumer Price Index, showed inflation coming down to 3%. And this sent the stock market on an absolute rally last week. But did you know that declining inflation, or more especially deflation, is actually bad for stocks? Now, I know this doesn't make any sense, but this is about to become abundantly clear when Tesla reports earnings on Wednesday, and it is especially going to become clear in about 2 weeks once the retailers start to report earnings. So let me explain what I mean here. The first thing you have to understand about earnings is just because a company reports bad earnings does not mean the stock goes down. So long as a company can beat analyst expectations, the stock will rise. And nowhere was that more abundantly clear than when Morgan Stanley reported earnings on Tuesday. Morgan Stanley's profit dropped, but because they beat analysts' expectations and the profit did not decline by as much as analysts had feared it would, the stock rallied with its largest single-day gain since 2020. Morgan Stanley said its profit for the 3 months ending June 30th fell 14% to $1.39 per share, but analysts were expecting a decline down to $1.20 per share. So even though their earnings dropped 14%, it didn't drop as much as analysts had feared. And that's why Morgan Stanley stock rallied on the day. It was up 6% as of the recording of this video. And the important thing to understand about banks is that banks across the board, both the large banks and the regional banks, have performed extremely well during this period of high interest rates. Increasing interest rates really increases bank profits. And we had a lot of fears about the bank balance sheets getting worse. They did get worse. But those fears have mostly appeared to be overlooked by investors as these stocks have continued to rally. Charles Schwab stock popped 12% after their second quarter result beat expectations. SCHW was up 12% as of the recording of this video. And other bank stocks, including Bank of America, also beat expectations and rallied as well. Now, one of the benefits about hearing from banks first is that banks have a lot of insight into the overall economy. And banks can give us a really good picture of how consumers are doing, whether they're doing well or whether they're struggling, as well as how businesses are doing. And it's important to look through what these CEOs said on their earnings calls to get a better idea of how the overall economy is. And for the most part, bank CEOs were extremely upbeat for the overall economy, which is great news for stocks. Goldman's chief economist cut their recession probability to 20% as they dismiss the yield curve inversion. Goldman's chief economist trimmed the probability of a recession in the next 12 months to 20% from 25%, which is well below the 54% median among forecasters who participated in the last Wall Street Journal survey. The main reason for our cut is that the recent data have reinforced our confidence that bringing inflation down to an acceptable level will not require a recession. Gross domestic product is tracking at 2.3% annual rates as consumer sentiment has rebounded, unemployment has fallen back, and jobless claims have reversed much of their mini spike. This all sounds like excellent news for the overall economy, and certainly if we can get inflation back below 2% without causing a recession, that would be amazing for not only the US economy, but also the stock market. Now, you should understand that this has never happened before in history. What Goldman Sachs is predicting is the first time in the history of the United States that the Federal Reserve has increased interest rates in order to get inflation under control, and that they have successfully done so without causing a recession. Every single time in the history of the United States, when the Fed has raised interest rates, it has caused a recession, 100% of the time. So Goldman Sachs is basically saying this time is different. This time, we're not going to get a recession, even though we always have in the past. And this bullish optimism has spread over to retail traders. Schwab CEO says bullishness among retail traders is rising, with buy orders 20% higher than sells. This means retailers are buying stocks way more than they're actually selling stocks. This is causing a lot of money to flood into the stock market, which is continuing to push prices higher. Now, it is rather interesting here how Charles Schwab CEO is pointing out that it is retailers who are buying the market as of June. So why is it that retailers are buying the market, but institutional investors aren't doing that much buying? Certainly, it could be quite a bit of FOMO, or fear of missing out. We could also have a little bit of the greater fool theory playing effect, where people are buying stocks out of pure speculation. They're not looking at the fundamentals or the valuations. They're just buying stocks because they think they're going to continue to go up. And usually, when retailers go on a buying frenzy, that very often marks the top of the market. And as Warren Buffett says, be fearful when others are greedy. Certainly, institutional investors have started to become a bit fearful of these overpriced stocks, but retail investors continue to buy. And based upon the overall economy and the economic news that we've had out lately, certainly there's a good reason to continue to buy stocks. But not everything is quite as frothy as it appears on the surface. Homebuilder sentiment also rose again in July, but builders are warning that higher mortgage rates are hurting business. Builder sentiment in the market for single-family homes rose 1 point in July to 56. Any rating above 50 is considered positive sentiment, although it should be noted that this is a scale up to 100, so we're just barely into the positive sentiment category at this time. Builders say that low supply in the resale market is driving demand for new construction, but higher mortgage rates and supply chain challenges continue to put pressure on the market. And even though home builders and CEOs are extremely bullish on consumers and the overall market, the data says otherwise. Jamie Dimon says U.S. consumers are in good shape, but evidence says he's wrong. We're trying to be really clear here. The consumer is in good shape, said JP Morgan Chase CEO Jamie Dimon. Dimon added, even if we go into a recession, they're going with rather good conditions, low borrowings and good house price values still, but the headwinds are substantial and somewhat unprecedented. Wells Fargo CEO Charlie Scharf said the U.S. economy continues to perform better than many had expected, although there will likely be continued economic slowing and uncertainty remains. It is quite possible the range of scenarios will narrow over the next few quarters, meaning we'll get a clear picture of how the U.S. economy is going to go over the next few quarters. And Citi CEO Jane Fraser said, I say we're seeing way more cautious consumer, but not necessarily a recessionary one. But there are reasons to think that many Americans would disagree with these upbeat assessments of their financial well-being. Consumer debt is rising, while the food and rent costs that pushed higher prices by inflation in the past 2 years likely are not going to go down. Many Americans still haven't tucked away money for emergency savings, and don't forget, student loan payments are returning in October. And this is one thing that confuses a lot of people about inflation. A lot of people think that if the inflation rate comes down, that means prices are coming down. And that's not necessarily the case. In inflation comes down, that does not mean prices are coming down. It means prices are still going up. They're just not going up as fast as they had been in the past. And the fact that prices are still going up and continuing to hurt consumers is something you really have to understand about inflation. Prices are not going down. They're still going up, just not as fast as in the past. Overall, inflation is up 18% over the past 3 years. And that's why 35% of people told Federal Reserve researchers they were worse off in 2022 compared to a year earlier. That is the largest share since Fed researchers started asking the question nearly 10 years ago. In other words, people are worse off now than they have been since 2008. And there's a lot of reasons why consumers are not doing good. Credit card balances stayed at $968 billion during the first quarter. Now, the first quarter is usually when Americans pay off the credit card debt that accumulated in the back end of the year, capped by holiday spending. But the collective balances did not decline from quarter to quarter. And this is the first time in over 20 years when Americans did not pay off their credit card balances in the first quarter of the year. And to make matters worse, while aggregate balances are not declining, the APRs, or the interest rates for those balances, are increasing due to rising interest rates. And while inflation rates are coming off of their 4-decade high, it's unlikely that prices will decrease for many grocery store items. Rents will almost definitely not decrease back to pre-pandemic levels. On top of that, consumers are slowly using up their cash buffers. So what we're seeing here is a consumer that's struggling with inflation. Prices are continuing to go up, not down, and consumers are having trouble paying off their credit card balances for the first time in over 20 years, and consumers are burning through their savings in order to pay their bills. All of this is signs of a struggling consumer, a bad economy, not a good one. And to make matters worse, federal student loan payments are going to come back in October. Now, to be fair, there's also the bullish view beyond bank balance sheets, and that is that the jobless rate fell to 3.6% in June, and the economy added 209,000 new jobs. The numbers could be interpreted as a sign the economy was cooling down without crashing into a recession, and that the Fed did not need to do too many more interest rate increases. And based upon that interpretation, that would be bullish for stocks. In addition, there's also some indicators that people are still spending. During the 2-day Amazon Prime Day, people spent a record $12.7 billion. But more people purchased the wide array of goods with buy now, pay later methods, in other words, more credit card debt, compared to a year ago. This has all led to an improving outlook that is aided by a strong job market and gas that's cheaper than it was a year ago. So if the American economy appears so strong and resilient with a very strong labor market and consumers that continue to spend, why is there such a big disconnect with the spending and the labor market compared to how consumers actually feel financially, and the fact that consumers continue to put things on credit cards, they're not paying down their credit cards, they're going into their cash savings in order to pay their bills? Why is there such a big disconnect here? Well, part of the disconnect may be just who we know and who we are in community with. People with good jobs and benefits may not know too many people who are struggling with debt or money worries. But the fact is, the squeeze that's happening on American cash flow is pretty hard to navigate for many, many households. So if you can understand that consumers are continuing to spend, but they're doing so with credit cards instead of cash, that will help you understand why inflation coming down is actually a bad sign for stocks, especially when it comes to retail stocks. Retailers' problems are getting real. Merchants are selling more stuff. We see this in the fact that consumers continue to spend. But the stuff that retailers are selling is often at lower prices. And that shows up in the data that inflation is coming down. The Commerce Department on Tuesday reported that retail sales in June rose by a seasonally annually adjusted 0.2% from a month earlier, which was less than the 0.5% logged in May, but the details of the report were certainly less discouraging. What retailers have found is that high interest rates and dwindling cash stockpiles are cutting into people's spending power. We also saw a decline in inflation. Second quarter price increases from the previous quarter at a number of retail categories, including department stores, clothing stores, and grocery stores, were slimmer than they were in the first quarter. We also saw deflation in a couple of categories. A lot of retail categories experienced outright price declines, including furniture and home furnishings, building materials, and supply stores, as well as online and catalog retailers, and of course, gasoline stations. But here's where the problem lies for a lot of these retailers, and this is something that's probably going to show up in Tesla's earnings that come out on Wednesday, is that as prices go down, a lot of the retailers buy inventory ahead of time. This is exactly what took down Carvana, so pay attention. As these retailers spent a lot of money on inventory, they're now forced to sell that inventory at lower prices because consumers don't have enough money to buy all of the inventory. And as these retailers provide these discounts in order to get through all of their inventory, this in turn causes their profits to go down, even if consumers buy more items. That is, even if retailers' revenue goes up, their profits decline because their margins have declined. And this is what took down Carvana. Carvana bought a lot of used cars at elevated prices, but they had to eventually sell those cars at losses once the used car market declined, and they ended up taking on heavy losses despite sales being just fine. And this is also what hurt Tesla last quarter. Tesla had a record number of deliveries last quarter, but their earnings, their profits, declined by 24% year over year because their margins declined. And this is why it is so important not to look at how much consumers are spending when trying to determine if earnings are going to be good or bad, but rather look at the margins that companies have in order to determine if those earnings are going to be good or bad. The higher the margins, the more profit a company makes. The lower the margins, the less profit a company makes. And for the past few years, we have heard companies from a wide range of consumer brands talk about their ability to have pricing power. That is, their ability to increase prices in order to maintain their margins, despite the fact that their costs were going up as well. But now we're seeing that's not the case. Businesses are losing pricing power, and they're forced to provide discounts in order to keep their sales up. This in turn is hurting margins, and that in turn is hurting profits. It's exactly what happened to Tesla last quarter when they were forced to reduce the price of a lot of their vehicles in order to keep their deliveries up, and that killed their profits. So this is something that we're really going to have to watch out for. Deflation or declining inflation is good for the consumer, but it's bad news for retailers and companies that sell to consumers, such as Tesla, because it means that margins are going down and in turn, profits are going down. And that's one thing investors are going to have to wake up to the reality of. We are no longer in a zero interest rate environment. We are no longer in an environment of free money. We're now in an environment of 5-6% interest rates from the Fed, which means 8-10% interest rates for businesses and consumers. And as interest rates have gone up fivefold over the past year, this means that consumers and businesses are spending a lot more money in interest, meaning they have a lot less money to spend on things that they want, but don't necessarily need. And this has the effect of hurting growth. And that means that all the growth stocks that had this incredible growth over the past 13 years are no longer going to be able to see that rate of growth in the future. And this is why up until 2008, up until we had still regular interest rates, the largest companies in the world were not the mega cap growth stocks. The largest companies in the world were more traditional businesses like ExxonMobil that were able to produce huge profits and huge dividends year after year. It wasn't really until 2009 when interest rates dropped to zero that we started to see the mega cap tech stocks become the darlings of the stock market. because those are the stocks that were able to grow exponentially because they were able to finance their growth at extremely low interest rates. But with interest rates back to more normal levels here, around 5-6%, these mega cap tech stocks are no longer going to be able to finance this mega insane growth that we've seen over the past 13 years. And that ultimately is going to cause a major, major shift in the types of stocks that consumers buy and hold on to. More likely, we're going to see growth stocks aren't really able to grow that much anymore. And that means their prices, their valuations are going to go down. And other stocks that more traditionally were held, such as value stocks and dividend stocks, are more likely to become the darlings of the stock market going forward. Of course, this shift isn't going to happen overnight. It's going to take a couple of years for market sentiment and consumers' mindset to change and wake up to this new reality. But it definitely looks like it's coming, especially if the Federal Reserve does in fact keep interest rates elevated like they said they would. And the fact is, the Federal Reserve is likely to keep interest rates elevated for many years to come because the war on inflation is a long way from being won. Very recently, rising fuel prices and a clogged housing market could cause problems ahead. City economists are worried that ideal conditions, which we currently have, which include a resilient consumer spending, stronger supply chains, and receding prices in key areas, may not last. Tight labor markets, elevated wages, and upside risk to shelter and other service inflation mean we do not share this level of optimism that most of the market has. Absent a tightening of financial conditions, inflation may reaccelerate in early 2024. And this is what we saw during the 1970s, and this is the big fear the Federal Reserve has right now. During the 1970s, inflation started to come down. The Federal Reserve lowered interest rates because inflation was coming down. And instead of inflation continuing to go down, it turned around and went back up. And inflation kept going up, and then the Fed would raise interest rates, get inflation down, they'd lower them, inflation would go back up. And this period lasted 11 years before the Federal Reserve was finally able to knock out inflation once and for all. And the Federal Reserve this time around doesn't want to be in the same boat. They don't want to be in this boat where they start lowering interest rates and then inflation comes back. And that's why the Federal Reserve is forced to continue to raise interest rates, especially since core inflation, which is what they really measure, still is well above 4%, which is well above the Fed's target of 2%. And the strong labor market actually has the Fed worried. Pay raises are finally beating inflation. After 2 years of falling behind, wages rose by more than 4%, while consumer prices only increased 3%. And in the past, when wages went up by more than inflation went up, this caused inflation to turn around and start going back up again. As consumer buying power increases, this very often will cause inflation to turn around and go back up. And this is the big fear the Federal Reserve has, and it's why some banks are worried that inflation is going to come back and this beautiful, wonderful, perfect economy that we're currently in might not last. And in one final sign that declining prices could hurt corporate profits, Ford has cut prices on its electric F-150 Lightning pickups by as much as $10,000. Now, we're not really sure if this is going to be good or bad for Tesla. On one end, Ford might be cutting the price of their F-150 because they're worried that the Tesla Cybertruck is going to take away a lot of sales. On the other hand, it might be bad for Tesla because this might force Tesla to cut the price of their Cybertruck, which in turn would hurt their margins. So these price wars are generally not good for the bottom line of companies. They're not good for corporate profits. And usually these things end up sending stock prices down. They're usually not good for stocks. So again, a lot of reasons why declining inflation is not good for stocks that deal with consumers, even though it generally is good for the overall economy, at least for the time being. Now, if you want to know how we're trading this and how we're making money during this earnings season and all the madness that's happening in the economy and the stock market, I encourage you to come join our coaching program where I can teach you how to trade multi-leg options, which are far more profitable than single leg options. And you can make money in pretty much any market environment with multi-leg options. If multi-leg options are something you want to learn, if you've been struggling, if you haven't been making money with options, maybe you've been buying calls and puts and just keep losing money and you can't figure out what's going wrong and you're ready to start making money, I encourage you to come join us in the coaching program where I can teach you how to trade the far more lucrative multi-leg options, and you can actually start making money with options instead of losing money. Of course, results aren't guaranteed. It does take a couple of years to learn and really become very successful. But if you're interested in getting on the journey and starting to learn so that you can eventually become profitable, then come join us in our coaching program. You can get more information on that by scheduling a call with the onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video on your social media pages. Don't forget to hit the like button and subscribe. And if you want the full analysis of Tesla earnings and what to expect for Tesla earnings that are coming out on Wednesday, make sure you watch the last video that I uploaded here.